if you're not protected some way right now, you don't believe in protection and you think everything's fine. I don't think there's any in between right here.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any references to performance of securities are thought to be materially accurate and actual performance may differ. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional.
And we are back with another edition of the Daily Dots. And I'm joined, as always, by the brain trust himself, Mr. Chase Taylor. Before we get into it, let's get a quick rundown of the indexes and get it out of control because, or get it out of the way. The indexes are part of the story, but I think both you and I would agree that we think that there's something much more important going on here, and it's getting...
a few things, yeah.
Yeah, a bit worrisome, also a bit unprecedented, and a bit concerning. But yeah, let's walk through the indexes real quick.
Yeah, S&P closed down 0.63, the Qs 0.37, small caps down a little over 2%, equal weight down 0.9, Mag 7 down 0.4. The rest of the world, ex-US, was up 0.4, so nice outperformance there. And that's thanks to the dollar, in part thanks to the dollar being down 0.32, and kind of flirting with a breakdown on the chart. Bitcoin down another 2.2%. Now you're under 110 at 108.3. Oil down yet again and barely holding on to 57 these days. Gold up another 2.6. Silver up another 3+%. Platinum, palladium both up big again. Copper, on the other hand, down again. That's been kind of the one metal not hanging in there lately. And on yields, you're down about 8 basis points on the 2-year, 5 on the 10-year. So yields and dollar down, stocks down, and then volatility up. You had front month vol up 8% and change. Spot VIX up almost 20%. And that's what we were talking about, kind of here in the last 30, 45 minutes.
Yeah, this has caught my eye, and we've been talking about it. The way that I have never seen the VIX and equities behave like this in a combined way. You show me spot VIX up almost 20% on the day. I'm looking at you and saying the market's down 2 to 3%.
Right, exactly.
You're almost flat.
And to me, the I guess more odd thing is doing like a 3-4 month look back. We were looking at VXX, which has a very negative carry because of the roll on VIX futures. That ETF is at like a 4-month high with equities in like a 2% drawdown.
And here's the other thing.
And it's been steadily bid for weeks.
Yeah, here's the other thing. Again, there is no perfect market indicator, but like I said, they're behaving. Whenever I have seen behavior, anything like this, where equity and vol are off, and it doesn't match, I have never not seen it lead to higher volatility and lower equity prices. I just never have not seen it lead. So my point is this: it's kind of like the old adage of equities being the dumb money and fixed income being the smart money. I don't think that that's true any longer, but I think that's very true in the case of volatility. Volatility is almost always the one that is telling you what's really going on. Equities are usually ignoring it. Now, full stop would be there is no 100% accurate indicator, and this would fall under that too. So right. I'm not telling you to load up. What I will say is this: that action made us add to hedges today, and what it looks like to me, if we're reading it correctly, and it's like other times, what it looks like to me is you're open. You got a trap door set for this market. And I will be very surprised if we do not see meaningful equity downside within the next week, based on what I'm seeing going on in vol and equities. The other side of it too is that when you look at what's going on, heightened trade tensions with China, look what's going on. Everything is telling you that volatility is right and equities are wrong.
Credit.
Yeah. Credit imploding in certain places.
Yep.
This should not be, NVIDIA green on a day like today, where it's bouncing off that little temporary support level you got at 180. which to me looks like Swiss cheese. It could carve through that in a second. I just don't like this here. I don't like it here. And I think the thing that bothers me the most here, which, bulls, maybe you should feel buoyed by this, because I've been over bearish too many times in the past. I've just never seen action like this that did not resolve it in the near term future with significantly lower equity prices and significantly higher volatility prices. I've just never seen it.
Same, and I've never seen, or at least I don't remember, vol being this persistently bid, like
over
for like
that
weeks
period
and
of time.
weeks and weeks. No matter if market's up, market's down, like vol just doesn't really want to go down. And I mean, at the end of the day, it has to be a lot of people buying those VIX futures and those VIX ETFs,
or buying puts in general.
While we know like retail is just, I mean, caution to the wind on the call side.
Well, and then little things. And again, you like looking at markets is like a detective. It's not like a scientist, right? And what I mean by that is you're taking clues, right? You really are, because it's like, well, I want facts. Well, tough thing about market facts is that it may be a fact, but we're all asked to draw conclusions on those, and the conclusions are not factual, right? So I like to think of it as looking at clues. Another one that bothered me is NVIDIA green on a day like today, with volatility doing what it's doing, knowing that NVIDIA is probably one of the 3 stocks holding up the entire market. And you can just look at that look at the number of stocks trading below their 50-day moving averages. Okay, all that stuff. When I see a day like today where it's green, but on lighter than average volume, that bothers me.
And to be fair, like, TSMC overnight kind of reports very nice looking forecast. They're saying, hey, we're growing better than we thought. Like, so it's great for chips. So in that backdrop, in the olden days, that would have been a 5% up day for NVIDIA. So the fact that you're only up like a 1, while let's see.
But this points to another thing of like, if you want to sit there and argue that NVIDIA, because of its margins and net cash and all that kind of stuff, deserves the valuation it's trading at, I think that argument can be made.
100%.
Okay, here's the tough part. The law of large numbers, like I've said, is coming into effect, right? So when you sit there and say that would have driven NVIDIA up 5 to 7%, the problem is a 5 to 7% move now is the equivalent of 100% of their annual revenue, right? I mean, 5 to 7% on a stock like that is $250 to $300 billion, right? And I think that's one of the other things. That's screw the valuation, guys. Look at these stocks at these market caps. You're talking about, why would you be investing in something that to move 5% means it's an increase of 1 times its annual revenue? I mean, think about that, right? A 5% move in a stock shouldn't be anywhere. I mean, that's the other tough thing that you've got being long these things. If you ask somebody, if you're getting long or you're big long NVIDIA here, what is your bull thesis? You know what I'm saying? Like, those margins can't hold.
Right.
Okay.
And if they do, like, that has its own set of problems for everyone else.
Yeah. If the margins hold, that might be the worst news for NVIDIA. But yeah, I don't get it. But I'm also not making a fundamental argument for why this market has to go lower. I'm looking at the fundamental side going, does a downward move in this market, generally speaking, make a lot of sense? Sure. But it's made a lot of sense for a long time. We've been trading at crazy valuations and frothiness for a while. The mechanical parts of what I'm seeing are giving me the willies.
Yeah.
We've said it before, said it again. My best indicator for market pullbacks has been the behavior of the VIX itself. I have never seen the VIX behave like this when nasty things weren't coming down the pike. You know what it kind of reminds me of a little bit? It reminds me a little bit of the lead into Volpocalypse, Volmageddon, when the VIX imploded higher. Because remember, in the days leading up, now it didn't last this long, but in the days leading up, you saw the VIX and volatility moving higher together until that one day before, market was up like 0.5%, VIX was up like 7. That's when we jumped hard into the VIX. Sure enough, it was in a day or two is when VIX exploded, right? Yeah, I looking at this market, looking at volatility, looking at stocks like Nvidia. I pulled up Nvidia's chart expecting to see it having a massive volume day for some reason. It was below average, even though it was trading green on a day like today. It just feels like retail. To me, it feels like the last guys at the party are keep holding it up right now, at least in the interim. Not talking about the big
Right.
party, but at least in the interim, I just retail is as bullish long as they can be in the over the short term.
So speaking of, they retail bought the most calls basically ever Friday when we had the 3% down move. So we finally get like a little downtick, and retail goes in and buys as many calls as they can get their hands on, while obviously somebody is bidding up vol. So it's just interesting. It kind of feels like a smart money, dumb money, like tug of war right now. And something we should definitely talk about is this credit side. Like we had the regional banking ETF down over 6% today. You had Jefferies down like 10%. You have Zion Bank down over 10%. Western Alliance down over 10%. Obviously, we had the First Brands insane fraud blow up.
And let me comment on that too. We may look back in a year or two and look at some of these moves on these regional banks as saying, "Oh, that was panic. That was overkick."
Yeah,
blah, blah.
SVB was the same. Yeah.
Okay, but here's the flip side of that argument, and I'll just tell you this firsthand. You don't have to agree with me, but here's I think the sell off in those names is wholly justified, because what I will promise you is that kind of crap is on a lot more balance sheets than the ones that we know about right now. Okay, and the index should be dropping because when things like this happen, you don't know who's got it and you don't know who doesn't.
Right. And that really came out with this First Brands thing.
Yep.
Obviously, there's some fraud aspect and $2 billion of assets disappearing, but that is a huge, huge part of the story. So I don't want to make it sound like it's all just everybody's dealing with the same thing. But, whenever you look at a bank's balance sheet, it's all pretty transparent. You know the loans, you know who's got them. And when it comes to private credit, private equity, you don't always know all the details. And there's all this like receivables, financing and stuff where they're selling off their invoices and to get the money up front. Like there's so much risk piled in that you aren't going to see. So if you're some pension, you're just writing them a check. You don't know.
Well, and there's
you don't
also
know what's going on in there.
Look, this isn't the right debt, and it may not be, or this isn't the right term, and it may not be the right way to characterize it. But there's, especially in private equity right now, there's a lot of coercive debt, meaning there's a lot of debt that on the surface of it looks okay. If you look at how it's been rolling, meaning, when it's coming up for maturities, how that debt is rolling, looking at the rates on it, it may not be obvious. For instance, when I see a big chunk of debt roll and it goes from a 4.5% rate to an 11% rate, that tells me something's in trouble. Okay, here's the problem in private equity. Nobody has an incentive to take a write down. Right? Because they determine the mark, unlike public markets.
Which we've been seeing a ton.
And so they can pretend and extend until capital dries up. And that's the deal, right? As long as they've got capital, they can continue lending to this corporation that may be a zero and they may know it. But bottom line is, and just think about it. If you're on that and you're like, hey, it is a zero. It hasn't gone the way we want, but maybe in 16 months, something changes, right? So instead of taking a zero on the entire investment, you go, hey, let's roll the debt one more time, right? And I mean, you're already not going to get paid back your money, right? So why not roll it one more time, maybe collect a few more interest payments, and maybe it plays out. My point is, there's a bunch of these funds packing around zeros that just haven't been realized yet. And they need to be. And the thing that's scary about it is when you look at the record amounts of cash that were on the sidelines for private equity. I heard a stat the other day. You got something like 8,300 private equity funds out there, and you've got like 7,500 companies that fit the billing to qualify for true private equity. So you've got more funds than you've got companies. This has actually happened recently. We've passed that mark on ETFs. Did you know that?
Yeah, more
ETFs than
stocks.
stocks.
Yep.
Okay. So guys, my whole point is when you add all these things up, okay, and you see the kind of stuff that we're talking about going on in the VIX, going on with individual, the indexes, if you're not cautiously positioned here, you're an idiot. I'm just, doesn't mean that we have to be right. Doesn't mean that a big crash has to happen. Maybe the market if you're not protected some way right now, you don't believe in protection, and you think everything's fine. I don't think there's any in between right here.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. Any references to performance of securities are thought to be materially accurate, and actual performance may differ.
Yeah, we had that, obviously, that ruption in the actual banking industry, the regulated banking industry from Silicon Valley Bank. Nothing bad happened in private credit, right? But at the end of the day, private credit just takes the deals that banks don't want to take,
Well,
which means they're riskier, they have more leverage, they're less regulated, they're less transparent.
and nothing.
So to think that nothing bad's going on under the covers there.
Well, and
this
it's
whole
not.
time.
Yeah, and it's not. It's a great comp, and I know why you're using it, but it's a bad comp in this. If you're taking any confidence from that experience, it's a bad comp, because remember, the issue there was government duration, right? The Fed just bought it at face value and just nuked that whole issue instantly, right? I mean, it was a duration issue that blew a hole in those banks' balance sheets. The Fed bought it at face value, and it was over.
It's not like private credit didn't buy anything stupid when rates were zero.
Right. And my other point is the Fed ain't going to step in and buy the debt books of a bunch of private equity
right?
firms.
Because then you're talking subprime auto loans. And
oh
stuff.
my God. Well, and then you look at some of these. A couple of these that rolled out,
vendor financing.
they had 6 to 8 loans papered on a single vehicle. And my whole point is, when you've gone as long as we have without a single credit event, everybody goes, what do you mean? We have not had a credit event, and we haven't had a default cycle, not even close.
Right.
When you've gone 15 years without a default cycle, I don't sit there and wonder if there's a bunch of crap on balance. I know there is. Of course there is. And watching these banks go, like I said, it's kind of like the one thing I know. I do not know how big this issue is. I don't know how pernicious it is. I don't know how widespread it is. What I guarantee you is it is on significantly more balance sheets than we've heard about at this point.
And to the point you made, it doesn't really matter until the capital stops flowing in, right? But now all of a sudden that 3, 4, 5 cockroaches appeared in the last month, because to be fair, like, we went a long time without really seeing too many real roaches. And there's never just one. So all of a sudden they start popping up, and it becomes cool to be like, oh, well, we had a roach too. We're going to do a write down. When that moment happens, if, and it's a big if some pensions and insurers and stuff are like, hey, we would like to downsize our investment for your credit vehicle, like, we don't like this backdrop, then that flow in starts to slow down, and then people have to start being a little more transparent and realistic with what they're looking at.
Well, especially in private equity, and I'll just go back to this. The mantra in private equity, you haven't heard anybody say it in a long time, unless it's coming from guys like us. But you know how long. I mean, this mantra was getting thrown around for a decade. Equity returns with fixed income volatility. And I just, look, all you need to do is tell me no events for a decade, and that is the mantra. And I will just tell you, that to me is one of the most. Now, the impacts it can have on the broader economy and the bigger market, I think, are much more scary, because those, but to me, there are a ton of roaches in private equity, and to the point where I think that there is enough to where it is economically disruptive.
Right. Like, unlike office real estate or something,
Yeah.
where you did the math, you're like, okay, that's a problem for it. It's not a problem for the economy.
No.
This, if it became a big enough deal, and if there's even more roaches than you think, it actually is systemic. Like, it messes with the economy.
Well, I want to say something like, I think like I want to say the Harvard endowment or something is like 40 to 50% illiquid private equity.
And most of the big pensions and endowments are wildly over invested into private stuff.
There's another, in my opinion.
I mean, private credit went from like nothing to like trillions.
Yeah. And that to me right there, that is another one of those signs that, again, just take it for what it's worth. Another one of those, of course, there's a massive, but, and here's why. When you see 50 billion endowment funds that are 40 to 50% invested in this illiquid stuff, what do you know? Here's what you know. If they were liquid, they would no longer be at 40 to 50%.
Yeah.
Right? They wouldn't. Not
Right.
Not when they look at this backdrop. Then the next question is, well, why are they still at 40 to 50? Ask yourself that, because they can't reduce it.
And some of them have been offloading. And that's clearly like a a first mover advantage, man. If you better be the first one out of that
100%.
Roach Hotel, if you will.
Well, yeah, go back to the Big Short. Like you go look at some of those stories. What was that one? Margin call, right? That story that was on the financial. Yeah, get out there and sell, but do it quietly. We don't want to start a panic, right? We don't want to ruin our own market. Private equity is very similar to that because you don't have a public market you can just dump it on. You got to find a buyer.
Well, to be fair,
ETFs, baby.
Yeah, to be fair, they've been trying that hard.
And we were saying that for the last year.
So it's funny that this comes out so shortly after the executive order to make it cool to like let mom and pop jump in on this thing.
Yeah, and that's why I said at the time, I was like, I think the Trump administration is making a huge mistake here. Maybe it's purposeful, so it's not a mistake. Maybe they're trying to help out their rich buddies. My feeling is that's one of those classic things that I could see a lot of presidents going along with, not thinking about the ramifications of it. Anytime the big Wall Street firms want to give mom and pop access to something, the fix is in because they don't want to give them access. What they're looking for is exit liquidity, right? I mean, pure and simple. So if that, they're spinning those ETFs up as quick as they can. Have they launched any yet? Have we got?
Yeah, they're out there. Yeah.
Have they performed well?
I assume not lately. I've been looking at the BDC ETFs, the business development companies where a lot of those private credits like house, and those have been, they had already been weak for a while. Now they're just getting
talk about a beautiful long short, be long public markets and short private equity.
Yeah, if you could do it the right way, especially.
Yeah.
I mean,
it would be phenomenal, especially if you can be short via shorting the ETFs. Right. Because I mean, that's where it gets spicy, because the problem of going against private equity is they determine their own marks for really until they're forced not to via a transaction or something like that. But you throw them in the ETFs and the game changes at that moment.
Yep.
So gold still ripping to the upside
every day.
Yep. And I think that, like I said, it's making me nervous. Anytime I own something that's going straight up, it makes me nervous.
9 weeks up in a row. And like we were talking about earlier, almost $1,000 within 3 months.
Yep. Tough part about that is, unlike so many things out there, when you look around the world, it makes sense. Again, it's not going to have pullbacks. It's not going to have corrections. It's freaking me out right now.
Yeah, it needs one. I'd feel a lot better if it had one.
Yeah, and truthfully, it probably needs a 15 to 20%er with the run it's had.
Yeah.
And that's not going to be fun.
No.
But
hey, you got to have a lot of fun in year to date. So
the other thing too,
doing business.
The other thing too, and this is the way you have to look at those things. That 15 to 20% shakeout's bound to happen. It's part of the game. That will yield some incredible buying opportunities in the underlying equities that are still. I mean, that's the toughest part of this trade. You and I were talking about before we came on. Am I concerned about? I'm concerned when I own anything that runs up the way that does. Now, do I think that there is froth in the gold price in the short term? Sure. I think there is. I don't think long-term gold at $4,000 with the backdrop we're looking at. I don't think that feels frothy. The weird part about it, there's zero froth in the gold equities other than the fact that they're up 130%, which by definition is froth. But then, and I was trying to explain it to a client today. I go, look, one of the gold mining stocks we hold is trading at 37 times earnings. Okay, that's high for even gold companies, right? But people have to remember that is a balance. That is the average, right? The earnings number they're using there is the average of the last 4 quarters. Okay, so you got to look at what the average gold price has been for the last 4 quarters. So here's a good exercise: take the average of the last 4 quarters of earnings, including this next one. So the last 3 and this next one, which is coming up right around the corner, and extrapolate those out for the next 4 quarters, right? Just say that those are the earnings. Now, those earnings, that probably means that you'd need to sell your gold at an average price of around $3,400 an ounce would be my guess. That's probably been the 32 to 34 has probably been the average. No, it's lower than that. It's probably like 3,000 has probably been their average selling price for their gold over the last year. Think that's fair?
Yeah.
Maybe slightly less, 2,800 to 3,000.
Cosmically higher over the last 6 months.
Yes, cosmically higher over the last 6 months. Okay, but take that number and extrapolate that number out over the next 4 years. Realize that number is probably coming from a $3,000 average gold price as opposed to $4,000 that we're currently showing, right? And then look at that number. that number basically cuts that earnings number in half. Okay.
The forward multiples are still not.
No, not at all. And then also remember that even after you do all that, that is giving absolutely zero value for the asset in the ground, the literal gold mine the company is sitting on. The problem with all of that being said is I'm not telling you to go load up on gold stocks because they're a can't miss. If gold does a 15 to 20% correction,
They can do a 40. Yep.
they will get ripped.
Yep.
And it doesn't matter what the underlying fundamentals say, especially in this market. When you've got Tesla at 260 times earnings, don't tell me you think gold miners are not going to pull back hard if gold pulls back 15 to 20, right? It just will.
Yep.
And people will sell it indiscriminately. Why are you selling the miners? Because gold's down. Idiot. Everybody knows that. Have you done the valuation work? And then I'm going to look at you and say, guys, no one's doing valuation work in this market. So don't worry about it. Right now, truthfully, if it was a healthy market, what you'd see is a 20, 25% pullback in gold, and you'd watch the miners move sideways over that period of time. That's what they should do. They're not going to. They're going to get drilled. If gold's down 20, they're down 40, like you said, and potentially more. Right?
Like pop on earnings and then kind of leak again and that kind of stuff.
Yep. What else you got for the folks? What are we looking for? My biggest theme today is just, hey, I'm seeing a lot of things right now. My opinion and kind of the way we're positioning ourselves is that, hey, if things still go up, we're probably going to go up with it, but we've got plenty of protection in the portfolio. We're not running around here naked.
Yeah, exactly. The only thing I'll leave us with is the trapdoor thing. I've been viewing it that way from the systematic standpoint for weeks, but especially this, since Friday. But I was even saying like, hey, this is just systematic. Like everything else is fine. So if we do sell off 10%, it's just because a bunch of machines had to sell. It's not because the world's falling apart. But these cockroaches and credit, it's like, okay, well, now we might pull back, and there's at least a little bit of thread of like real stuff that's concerning in the background. So if more roaches show up, whether it's in credit or other parts of the economy, or just geopolitics or trade or whatever, like then it, the spicy level, using the Thai terms, maybe go from 2 to 3 or 3 to 4 or something. So just something to think about.
How many stars are you? What do you?
All right, so Tongue wants all the way.
What's the name of your place?
Easy Thai, Easy
Go. Easy Thai, Easy Go.
Free advertising for.
And it's solid. It's solid.
Purdy Washington's best.
Really good.
My tongue wants that. My stomach is like, yeah, you should probably stick with 3 or 4 stars, not 5.
Oh, but you'll roll 3
It'll light my stomach up if I go really spicy.
Yeah, see,
I'm not full blown. It depends on the restaurant. Some places you're like, I want Thai hot. Give it to me, the good stuff.
No.
And you're fine. And then there are some of them where you're like, I would like you to dial this back 30%, please. It just depends on the place.
Yeah, so that's growing up in Gig Harbor versus Houston.
Yeah,
I am a 1-star guy.
Oh wow.
I
love the heat.
Yeah, so it's a little embarrassing, honestly.
But I'm a Browns fan. We know I'm a masochist, right?
Well, I'm a Mariners fan. I mean, good God, look what I put myself through last night.
Yeah, that was tough.
Yeah,
that was a home run derby.
If somebody would have told me I'd have spent that much money taking my family to a baseball game just to watch that,
pick the wrong one.
No, but that's what being a Mariners fan. Hey, so you finally your team finally makes the ALCS. You finally get to go to a game. Yeah, and I have no idea why I was expecting something different. Right? I'm lucky I left with all my limbs. Honestly, as a Mariners fan, I mean, typically, if it would have been being a Mariners, I'd have walked outside, all my tires would have been slashed, windows broken out, and I'd have come home to a house fire. That's what being a Mariners fan's like. It's even worse than the Browns. I hold on proudly to the fact, historically, we are the worst professional franchise in North America.
I'm about to run some analysis on this.
No, it's true. Only professional franchise in North America that's been around for 25 years or more that has not been to a championship. Only one.
The Browns have not in the Super Bowl era. And we've been to the playoffs 2 times since 1999, which is pretty close maybe to you guys. But
you've been.
And we haven't won a division since I was less than 10 years old.
But you've been.
Never been to a Super Bowl.
Well, yeah, but you've won an NFL championship.
Oh, yeah, like when,
Paul
when
Brown.
there was like steamboats and
he
horses and buggies.
So he had to hand crank his car to get to the stadium for the game.
Yeah, the guy that invented the shotgun is the one that won those championships.
I mean, that's a lot to hang your hat on.
It's been around for a minute.
That's a lot to hang your hat on. He was good buddies with Mr. Remington. They went to the games together.
Paul Brown was awesome. You should read a book about him. He's great.
It's more than we have. More than we have. Anyway. All right, you guys, that'll do it for us today. Have a wonderful evening. Why is our camera not flipping back? Oh, there we go. Have a wonderful evening. And as always, follow us on social media, on Twitter at KYR Radio. Chase is at Pinecone Macro. Search us on YouTube. Just Know Your Risk Podcast. Go to knowyourriskpodcast.com. Download and subscribe. Got a good slate of interviews coming up too with some interesting folks that should be good. So anyway, have a wonderful evening. We'll see you tomorrow. You're listening to Know Your Risk Podcast. Download and subscribe to knowyourriskpodcast.com.
Investment advice cannot be given without a client service agreement. Zach Abraham is an investment advisor representative of Trek Financial, an SEC registered investment advisor. Bulwark Capital Management is a marketing name only and does not carry a separate registration.